Good morning, Real ECN listeners. This is your Forex market commentary brought to you by Real ECN. What a dramatic sell-off it was on the euro-dollar market over the past few days. If you had short positions on the euro, congratulations on your winning. Today's commentary, we will cover the euro on the technical level and see what the technicals are telling us from a perspective of a bull or bearish undertone. On the fundamental front, we will touch on factors that can affect the risk appetite, which the euro is highly correlated to. First in line, we will talk about and examine the euro on a technical level. Here we have the euro-dollar pair on an hourly time interval. Over a span of one trading session, the market observed a dramatic euro sell-off from the 1.3900 zone to the 1.3700 level. The underlying reason for this major sell-off on the fundamental front is the hawkish rhetorical from the Fed during Wednesday FOMC meeting, as well as yesterday's upbeat US economic report. On the technical front, this sell-off could be linked to the euro failing to break out from its multi-years resistance level established at a range between the 1.3830 and the 1.3970 mark. The importance of this range cannot be underestimated as it falls in line with the 2008 and 2010 50% Fibonacci retracement decline, as well as the 61.8% retracement from 2011 and 2012. Therefore, analysts are expecting short-term cyclical rebounds for next week and highly recommend shorting the euro at any rebounds to the upside. With reference to the SSI, which is also known as the Speculative Sentiment Index, net retail traders' position on the euro-dollar cross painted a bearish sentiment on the euro. A few trading sessions ago, when the euro was trading at the 1.3900 level, net retail short positions represents an extreme sentiment on record. There were approximately 8 outstanding short euro positions for every one long position. However, now that selling pressure appeared to have been exhausted, at this immediate time, outstanding net short position had been leveled off as well. Currently, there are 3 outstanding short euro positions for every one long position. Extreme crowd short positions often reflect the top in the market, and this can become clear as the market price action develops in the coming weeks. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar market is suggestive of a temporary bearish market sentiment and recommends short position on the euro. The euro-dollar pair began today's Sydney trading session in the congestion after rebounding from the mid 1.3700 zone with a current price action at 1.3777. However, inching closer towards the established short-term Fibonacci support at 1.3775, while the Fibonacci resistance is set at 1.3783. The euro-dollar pair continued to trade below the 200-day moving average when it first dipped below this significant moving average during the FOMC meeting. This trend action holds great significance as 200-day moving average contain more or less of 1 year's worth of trading data and it forecasts long-term market sentiment, and currently the pairs are trading below the 200-day moving average, which is indicative of a long-term bearish market sentiment on the pair looking forward. This bearish market sentiment is also supported by a short-term moving average on the euro-dollar pair as it opens today's Sydney trading session in line with the 5 but below the 10, 20 and 30-day moving average, which is indicative of a temporary sell recommendation on the technical front. So let's closely examine some indicators on the euro-dollar pair. On this hourly time interval, we have the RSI, which is a momentum oscillator. We can see that the price value of 44.2050 shows that the trend dipped below the simple moving average on the 200-day level, which is reflective that the RSI is levering at a neutral and turning bearish. So going down here, we have the CCI, which is the commodity channel index. It flashed between the buy and sell signal. Currently, the selling pressure has been exhausted and buy signal on the euro is at an early stage of gaining traction as it rises above the 0.00 mark. So let's closely examine the euro on the component that affects this market. And one of the components that affects this market is fear. And here we have the VIX, which is the volatility index. VIX is often used by traders to measure the level of fear in the market. Current level of fear is relatively low, therefore it poses very little threat to risk appetite. Remember, risk appetite and euro-dollar pair rally goes hand in hand. Moving down here, we have the S&P 500. S&P 500 and Euro-dollar pair are both highly correlated to one another, and they rally on strength of risk appetite sentiment in the market. Wednesday FOMC meeting in the market saw a hawkish Fed rhetorical as an end to an era of easy money, while this can translate to a sell-off in the S&P 500. However, today we saw a rebound in the S&P 500 due to the Philly Fed index and U.S. home sale that also pick up as well. So here we have the emerging market MSCI ETF index. Emerging market index is often used to gauge fear and also measure risk appetite in the market as well. One factor that can hinder risk appetite is emerging market fear. Investors are paying close attention to the Ukrainian issue and the slowdown in China. And right now, as we can see that this fear level is still contained because the sell-off is not too extreme as seen in late January. So monitoring the development of this emerging market ETF is also can give us a headwind start to how much that fear can spread to a fall on risk aversion. So moving on to the fundamental front on the euro-dollar market, Wednesday FOMC meeting clearly has set the stage for this reversal in the euro-dollar market. The rally in the greenback was largely underpinned by a shift in monetary policy by the Federal Reserve Open Market Committee as they signaled to the market their willingness to pursue a tightening policy as the outlook on the U.S. economy improved. However, it is also important to understand that the committee did not see a rise in the U.S. main refinancing rate to pick up until 2015. After digesting the FOMC minutes, the market are optimistic about pricing in interest rate expectation for the greenback. Yesterday, the U.S. reported its highly anticipated existing home sales number that came in line with consensus at 4.60 million homes. In addition to that, the release of the Philadelphia Fed Manufacturing Index was an upbeat reading, coming at 9.0, beating expectation of a 3.8 U.S. Reading. Also in line with that is the U.S. initial jobless claim also dropped from 320,000 claims below forecast of 325,000 reading. The euro-dollar can be characterized as a risk trade. Having mentioned that, most euro price swing can be influenced by concerns over emerging market that span to include slowdown in China as well as escalating tension between the West and Russia over Ukraine. Ever since the U.S. slapped sanctions on Russia, the Russian retaliated by banning U.S. officials from entering into Russia. Adding insult to injury, Obama vowed to sanction the Russian industrial sectors. This escalating Cold War-style tension posed itself as an impending risk to investors' risk appetite, and since the euro-dollar is highly correlated to risk appetite, this can dampen future expectation of a euro rally. The other component in this risk aversion fear is credit tightening conditions in China. Credit default in the world's second largest economy is becoming more and more of a prevailing theme. As of recently, a Chinese steel company defaulted on its 3 billion yuan bond payment, and with the Chinese government making it clear that it's no longer willing to bail out failing company, this action can perpetuate risk contagions throughout emerging market. On the domestic front, yesterday trading session euro sell-off can be attributed to Germany PPI number coming in lower than expectation. The German PPI number month-on-month came in at a stagnated reading of 0% when expectation was running at 0.1%. This only reinforced concern over slowdown in the inflation reading in the Eurozone, which can ultimately hinder any ECB options to scaling back existing accommodative policy. To conclude this commentary, I want to thank all our listeners for listening and stay tuned for the next commentary on Monday.